Welcome back to What's Hot, What's Not. CRE, your daily pulse on commercial real estate in America. It's Friday, February 6th, 2026. Today we're tracking where institutional capital is flowing and what smart money is avoiding. All right, let's start with what's hot. And honestly, there's no contest. Data centers are the undisputed winner for capital deployment so far in 2026. The numbers are staggering. Hyperscalers alone are projected to spend anywhere from $300 to $600 billion on AI infrastructure this year. We are in a full-blown investment supercycle for this sector. Some estimates project a need for up to $3 trillion by 2030 to meet demand. The global sector is growing at a 14% compound annual growth rate over the next 5 years, which could unlock $1.2 trillion in real estate asset value creation. And the fundamental driver for site selection has shifted. It's no longer just about location or cost, it is all about power availability. That is now the #1 factor. Staying in the hot category, industrial logistics remains incredibly resilient. Tenant demand is stable, buoyed by the familiar trends of e-commerce, manufacturing, and nearshoring. The big story here is on the supply side. New construction is down 42% from its peak in 2023, which means supply is finally moderating and giving the market a chance to breathe. We are seeing a construction uptick in places like Texas and the Southeast, where absorption stays strong. The assets in demand are exactly what you'd expect: strategic locations with superior distribution access and a deep local workforce. One more hot sector to watch: build-to-rent single-family. It's gaining serious momentum. Projections show BTR could hit 15% of all single-family housing starts within just 5 years. With limited deliveries coming online, rent growth is accelerating. Institutional capital is drawn to the high tenant retention rates and the premium rents these communities can achieve. Now for what's not. To no one's surprise, office remains the sector smart money is avoiding. The simple truth is that office-using jobs still haven't recovered to their pre-COVID peaks. Class B and Class C office properties are facing the highest risk of distress by a wide margin. The only segment seeing real rent growth are the absolute top-tier trophy Class A buildings in prime central business districts. And those conversion plays we hear so much about? They are far from a simple solution. They're complex, capital-intensive, and often don't pencil out. Beyond the office sector, real estate debt distress persists. Specifically, the 2021 and 2022 vintage floating rate deals are under immense pressure. The higher-for-longer rate environment is squeezing refinancing options dry. We're seeing lenders get much more defensive, requiring larger reserves, particularly for struggling Class C assets. Interestingly, this is even causing some capital to look to Europe, as a few investors begin to question the U.S. political resilience ahead of future elections. So, what's the final investor takeaway for the week? First, follow the capital. Data centers and industrial are where the smart money is going. That's a clear signal. Second, build-to-rent offers powerful demographic tailwinds and the promise of stable cash flow. When it comes to office, it requires extreme selectivity. It's trophy or nothing. And finally, real estate debt opportunities are emerging, but they are for patient capital willing to work through distressed situations. 2026 is about income and conviction, not about speculation. That wraps up the week. Have a great weekend. Don't forget to like, share, and subscribe. Visit hotnotcre.com to learn more and subscribe to our newsletter.